Hello and welcome to the Investor Master Series. My name is James Boyd. We welcome you. We got Barbara Armstrong in the chat, fellow instructor. We welcome her and all of you here as well. Michael, Grace, Ray, Lola, Gary, and many others. Good morning to all. I'm in Salt Lake City. It was over 60 yesterday in Salt Lake City. It felt amazing. Felt like I was in Miami, okay? Especially after coming out of the frozen weather. To feel 60, almost got a sunburn, having Irish skin and all. So let's go ahead and get started. Now, this topic or this title for this class, which is not a one-off class, this is being recorded, okay? Investor Master Series. We talk about stocks, technical analysis, options, fundamentals, right? We want to kind of try to bring it all together. And so this conversation will probably be intermediate or higher. That doesn't mean if you're a beginner, you can't get something out of it. It's just we plan on it being intermediate or higher level. Now, also remember when we get started here today, when we talk about stocks, which we will talk about, we will also bring up options in combination with stocks. Remember that options carry a high level risk and are not suitable for all investors. The information provided here is for general informational purposes only. Also understand that when we talk about examples, those will be done on the Paper Money software application for educational purposes. Investing involves risk, including loss of principal. And this is kind of something we said yesterday, which is the first job of the investor is to protect capital, right? And on any given trade or investment, you're taking risk. So we always want to understand what that risk could be. And also remember that when we talk about short options, those could be assigned at any time up to expiration, regardless of the in-the-money amount. We're talking about American options, style options, okay, not European, where it's only at expiration. And also today, what we're going to really cover is we'll talk about markets, okay, where they are or where they're not, okay. And we'll also talk about, we've talked about the last couple weeks. So let me show you something just really quick. So first off, for our class, here is our class link, okay. This class link will take you to the playlist, okay? So see in the chat, I sent you a link, and this will get us to the Investor Master Series playlist. Now, in the last couple weeks, just to kind of give you a sense or taste of what we've talked about, we talked about why married puts and callers, okay? Week before that, exits and option protection. Those are the last 2 weeks that we've talked. So on any class that we do, it's going to be added to the list. That way you can go back and study, not just view at one time, but go back and watch some areas that you feel like you want to improve in or need to. So first off, there's that. So when we also go back to this, I want to kind of bring up some of the questions that were asked to me. This second agenda item that we're going to talk about is understanding the delta on the married put and or caller position. I think a lot of times we don't really understand what that put is doing. If the stock goes up or down or goes sideways, want to kind of bring up an example. I want to kind of talk about the math of that and the example of that because I've had some questions on it. So I want to answer those questions. Second, I want to talk about when markets sell off, what is maybe the first agenda item? Is it to put on bearish positions or is it to manage existing positions first? What comes first, the cart or the horse? We're going to talk about that, okay? And why do we kind of talk about it the way that we do? And the last but not least is I want to kind of talk about bearish strategies that I've had some questions on. And I've had some questions on a strategy that we'll bring up. And I won't let you know yet, but we're going to go there. And I want to talk about maybe 1, 2, 3 stocks that might still be under pressure, okay? So the theme today is really kind of understanding protection, okay? That's huge. And also a bearish or two strategy. Now, what I want to do is here, let's bring up just real quick the SPX. Now, in the last 10 days or so, we've been talking a lot about one of the oscillators called the stochastics. And I don't know about you, but I'm starting to wonder if that stochastics really needs mouth-to-mouth resuscitation, okay? What you're going to notice is we cannot get out of that oversold area to save our life, okay? We can't get above that 20 oversold line. Now, if you go back and look at, let's say, the moving, which by the way, is kind of nice because the oscillators are kind of telling us We do not have bullish strength. When we go up to the moving averages and keep it as simple as possible, the moving average lines, they're on fire, okay? Fire. Now, when you also take a look at this, when you go back to, let's say, this date of February 20th, okay, about 2.5 weeks or so, we've had an up day, but it's not cold, okay? And it's not an up day that leads to a change in the color of the moving average. So a green color candle like that does not matter because it didn't change the trend, okay? Or it wasn't cold, or it didn't actually change the moving average color. Well, you're going to notice actually on top here, we see a red dot. Well, the red dot is just the inverse version of hold. Close above the high of the low day, a bullish bounce. Well, if we get a red dot, that's just a bearish bounce down. Now, is that a good sign or a bad sign? Well, if you're a bull, okay, we only had 1 day up, and then what you're going to see is the very next day, we went down, but it didn't close below that low. That's why on this day right there, let me circle that. That's why on that day, we closed down below the low of that day. And that's why that red dot is there. Now, we talked about this yesterday, how to turn those dots on. You're going to see that we only went up for 1 day, and then we saw that the price closed down below the low of that day. And the same thing again is right there. And where did we close? We closed below the low of that day. So first off, not a good sign when you only go up for 1 day, only to be attacked by those vicious grizzly bears out there, okay? And if you look at this, kind of those moving averages still red. Now here's the thing. We said the number one thing is if the market's not showing a signal, it's okay to say, look, cash is a position, okay? Cash is a position. The investor is trying to put on positions when it makes sense. If it's not giving that trend, even though that investor is so impatient that they want to just buy something, you might as well just go out there and buy a sucker or bubble gum. If you just want to buy something that bad, go buy something else that actually you might get more enjoyment out of. Because when we look at this chart, it's not giving a signal for a potential entry based on oscillators. Did any of you laugh at that? You should have laughed because sometimes we just want to buy something. Maybe go buy something else, okay, that you could consume, okay, and where there's potential less risk, okay? Now, when we look at, let's say, the NASDAQ, which has been also really the stinker to the downside, you're going to see, is there a little divergence? The problem in the last 2 days, the divergence that we had on the MACD, it snapped. What do you mean by that? It actually... Well, we had a divergence, and the last 2 days, we fell down below that last trough on that MACD, and we went even lower. So that's not great. And the same thing goes on the stochastics, not great. So the NASDAQ here, not being very nice. Now, I said a lot of negative, okay? Do you have anything positive to say? I do, okay? I really do. So when we look at, let's say, the Dow Jones, we're kind of down near this area of support. And we've seen this before where the market will go down near an area of support and our moving average. It will show an ugly candle, look like we're going to break the floor, you make it even worse, only to see it snap back up, okay? So the one thing is, at least on the Dow, among others, we're in that area where we could start to see that support level. Now remember, when I say that, that doesn't mean it's today. That doesn't mean it's tomorrow. That means we start watching for some of those stocks that could be bouncing. I said yesterday I'm going to repeat myself, which I never do. The biggest actually thing is when you look at the VIX, the higher it goes, the more interesting it becomes from a bullish perspective. Because, well, if you're a bear and you want to go buy puts, the puts are more expensive, which means the stock has to drop down more to get to the break even, which might be a low probability strategy. If we actually have, let's say, the VIX go up higher and higher and higher and higher, prices on stocks have come down lower and lower and lower down near support levels. So it's kind of like good and bad. I mean, do we want the stock market to go down or not? Well, if I'm trying to buy, I want it to really get creamed, okay? But the biggest actually thing is when we look at the volatility, as the market's gone down like a water slide, the volatility is shot like a missile to the upside. And this is why we kind of say that when that volatility goes up, you got to be very careful, because that means that stocks most likely are going to breach support. And in this case, it just hasn't stopped. Now, are there any questions with what we've talked about so far? So if we kind of said, is there any index that might be the closest to getting a bounce? We would probably say in this case, Dow Jones. Okay, Dow Jones would probably be the one index that's maybe the closest. Second would really be the SPX, which is really getting back down to where this support area is right here. And also, you're going to see that it also has other sectors that are representative, not just a high percentage of stocks in technology like the NASDAQ. Okay, now I just want to speak to kind of some of the things we're seeing. When we look at gold, has gold been crushed? It's pulled back from the very top, but it's within 2% of the high. Silver, if you take a look at silver, prices itself, silver hasn't necessarily fallen down either, okay? And when you look at that other shiny stuff, copper, you're going to see that copper doesn't look like it's been pushed down very aggressively. It kind of looks like it's loading up an ascending triangle, okay? Now, with kind of some of the dampening we've actually seen from tariffs, et cetera, on maybe what it might do to the economy, we have seen crude oil get pushed down quite dramatically, okay? Which in one way or another is maybe a little win for consumers, okay? Now, what I want to do is kind of just bring up, are there any questions? Yeah, now Bill actually says with an additional headwind, NASDAQ seeing a little green. So let's pull that up. Bill made that comment. Let's pull this up. And if you look at this and say, is it seeing a little green? Yeah, it's seeing a little green. Turning around, okay? Now, the one thing we got to be careful of is when we see a green colored candle, like we saw here, that was not go hold. This was not go hold either, and neither was that. So we're going to need probably a larger green candle that closes above yesterday's high. If today we just get a green colored candle, it's nice, but it's not enough to really cause a change in the trend yet. If we zoomed in and said, see any color change in the moving averages on either? No. Do we see any change on the stochastics out of the oversold region? Not yet, okay? Now, these are ways we try to definitively monitor the trend of the market and the momentum, and it's not yet. We don't see it. It's just what it is, okay? Now, I want to also kind of go back to understanding. The second agenda item I want to talk about is understanding. The last 2 weeks, remember we talked about the strategy of why married puts. So for some of you that are saying, I don't really know what that is. It's we're buying shares of stock, and at the same time, we're buying a put. Now, one of the things that I think is tough, when volatility goes up, the investor says, hey, I set a stop. And then I was very good about getting stopped out. I think most of us have had that. I've had that, okay? And so some people, they don't use stops. They try to use options as a way to protect their stock position, okay? Now, what I'm going to do is let's bring up an example of this. And I want to kind of talk about understanding the delta on the position, okay? Now, when I pull this up, I want to look at, let's say, I'm going to pull up this. And one of the ones we've been talking about just a little bit is the Altria example, okay? We've got other examples we're going to pull from, so don't worry. We have shares of stock. Now, why do you buy shares of stock? Well, you buy shares of stock because you think it's going to go up. Exactly. What we're concerned about is wonder if we're wrong, okay? And the reason why the investor bought the put, now when we buy the put, what is the length of time that we've been talking about in terms of duration of how long we're buying the put for? Well, most of the time we're talking about the monthly option, 20 to 40 days to expiration. And we're talking about picking the put that typically actually has a delta of 30 to 40, which means that's out of the money, which means that's below the current stock price, hence downside protection. Now, I want you to take a look at this right here where it says Delta 100. Now, I don't need to repeat this, but if the stock went up $1, you already know that you'd be up $100. You know that if the stock went down $1, you'd be down $100. All it is you're taking, if you have 100 shares, 100 delta. Think of delta as the change in the profit or loss, unrealized profit or loss, if the stock were to go up $1 or down $1. So if you had 200 shares of stock, the delta would be 200. So if the stock went up $1, you'd be up $200. Stock went down $1, you'd be down $200. That's nothing new, okay? Now, where it gets a little different is we have this put right here that is a little bit more dynamic. And that delta on the put is negative. Does anybody know why that's negative? Why is the put? So stock is positive delta. What is that? Well, anything that's positive delta is a bullish position. Anything that is negative delta, that's a bearish position. Okay? Now wait. So when someone buys a put, it's a bearish strategy. It's negative delta. And what you're going to see is that negative delta, it says negative 13. That negative 13 is saying what are the statistical chances of the stock to close below the strike price by a penny today? No, at expiration. Just want to make sure you're listening. Second, how does the delta change? That's the second question. How does the delta change? Well, the delta changes by the gamma. So the delta, you can think of it in the first is the first dollar move on the stock. And gamma is the additional probability or the opposite if the stock were to go up or down. Let me show you what I mean by this. So let's kind of look at this math because I'm going to tell you, I don't think you're ever going to trade the strategy unless you really understand the movement. So we understand that on this position, we have 100 shares of stock, 100 delta, and we got a long put that says negative 13. So if I said to you, what is the net delta, what would you say? Well, the net delta there is just 87, okay? So if you did a stock position and you bought a put, is that as bullish as being long the shares only? No, it's not, okay? It's a little bit less, okay? Now remember, when you take a look at, let's say, a bullish position, the highest delta that you can go, given that you have 100 shares, is 100. If you buy a put, it lowers your delta a little bit, okay? Now, we said before that when you take a look at this, the gamma is 7, okay? So I'm going to kind of put this column as delta, and then we're going to do gamma. What was the gamma? Well, the gamma is 7, okay? So let's imagine the stock goes up $1. Help me out here. If the stock goes up $1, how much is the stock going to gain if you have 100 shares? Well, we know it's going to be $100, okay? Now, if the stock goes up $1, do you still have the same probability of the stock being below the strike price? And the answer is we shouldn't, because the stock went up. And so the delta currently right now is negative 13. But if the stock goes up $1, the delta would become less. Why? Because the stock went up. Why? Because there's less chance of the stock being below the strike price. And so now if we still have the 100 shares of stock and the long put delta now is negative 6, what's the net delta now of the two? So when I say net delta, I'm just saying the shares of the stock and what's the delta in the put. Well, the delta now is 94. Did your overall position become more bullish or less bullish? Answer that question would be, look at the delta on the bottom. If your net delta on the bottom is becoming larger, your position is becoming more sensitive if the price were to go up in a good way, or more sensitive if the stock were going to go down in the shorter term. Now, last but not least, if the stock goes up $2, we know the stock could be up another $100, and now the delta should be probably close to 0, okay? And now what's the net delta? Well, if that stock goes up another $1, the net delta in the position is like, it's probably close to 100. And what's happened is as the stock goes up, the delta declines. That's very important to understand that. If stock rises, delta declines, okay, and makes, or could make, okay, delta, I should say net delta, okay, rise. Okay, which by the way, is that a bad thing? Not necessarily, because it means if you get the direction right, you get more potential benefit. Flip this. Okay, let's flip it. Well, if we took a look at this and said, okay, now that stock actually goes down, and this is really what we wanted to get to. Okay, but let's start with kind of the way we think. So if that stock goes down $1, how much are we down? Well, we're down $100. Now here's the deal. I need some help here. If the delta on the first dollar is 13, and all of a sudden the stock went down, does the probability increase that we could be below the strike price? And the answer is, you better believe it, -20. Now, we're just taking delta and adding gamma, -20. What's your net delta now? Well, you would actually be, in this case, you'd be down, your delta would be literally 80, okay? So in that first dollar, the delta was 87. And if that stock drops, the directional sensitivity declines. Why? It's because the put delta is being more protective. Why? Because when you buy the put, you have a right to sell the shares at the strike price. Why is that probability changing? It's where the stock is in relationship to the strike price, how volatile actually that stock is also as well, how much time you have to expiration. Let's speed this up. If that stock goes down another buck, we know we're down another 100 on the shares. But if the gamma stays the same 7, the delta there would be about 27. And all of a sudden now the delta is now down to 73. We speed this up even more. Stock goes down another dollar, you're down another $100, and the delta is now 34 if the gamma stays 7. And now all of a sudden you're down 66. So the long put is offsetting potentially some of the losses on the what? Guys and gals, this is what people don't understand. People do not understand this, and it's okay. That's why we're talking about it. That's why I've had questions on it. When the stock goes down, the delta of the put becomes more negative, and it's actually protecting the potential loss, some of it, on the shares. The net delta on the position is becoming less and less. Why? Because it's actually getting, it's having a greater likelihood to become in the money on the put, okay? And if you look at this, if that stock, and I'm going to show you some examples, if that stock goes down again, notice the delta is rising, and we hit that pretty hard, and if that delta actually goes, if the stock actually goes down to the fifth dollar, the delta was 7, but as the stock goes down $1, $2, $3, $4, $5, the delta is rising, statistically saying that the chances of that stock closing below the strike are becoming higher and higher. Therefore, the profit or loss sensitivity is higher, offsetting some of the losses on the shares. The key word is some. And when you look at the net delta when the stock drops, the net delta in the position, when I say net delta, I'm saying the stock and the long put combined. And what you're going to notice is the position is not becoming more and more sensitive. It's becoming less and less sensitive. Now, how many of you wish, raise your hands, how many of you wish you had bullish positions that were less sensitive to a price decline? James, don't ask a dumb question like that. Of course I would, but do hands up, okay? Well, I'm telling you, why didn't you do it? Why didn't you do it? Why didn't you call it the position? Why didn't you buy the put? Why didn't you sell the stock? Whatever. What it really comes back to is I don't understand kind of what's happening. That's why we're opening up the hood on this. The major point to take away is that when the stock drops, and if it were to drop quickly, the delta of the put is rising, and it's making the net delta, let me repeat just to clarify, when I say net delta, I'm talking about the long stock delta and the long put delta. So when I say net delta, I'm saying those two in combination are becoming less and less and less negative. Okay? So the investor, why are they buying the put? Because they want blasted protection. That's why they want the put. Now let's speak to this real quick. Okay? Now, if we take a look at this, what do we want the position to do? Like we said before, we don't want the put to gain value, because if the put gains value, the married put is a bullish position. So if the put becomes valuable, that means the stock has gone down. Well, why do we care? Because on a married put position, stock in a long put, it's a bullish position. Stock goes down, we're overall losing. So the investor who understands this doesn't mind that the put loses value. Now I want to kind of give you a joke, okay? Let's say the investor goes out and they buy protection on themselves. Well, if they said, yeah, I spent X amount of money on myself to protect myself that I'd stay above support, okay, and I didn't break support this year, if you follow where I'm going with that, it was foolish of me to do it. Well, you're still alive, okay? It's the same idea with the shares. We want those shares to stay up and go up. So really the put is really the premium cost, if you will, for trying to define the risk and control the risk of capital, okay? Now, let's kind of look at the other one real quick. We've been talking about the last 2 weeks on Amazon, okay, which has not been a very nice position at all. So we have 100 shares of Amazon. And let's kind of speak to this just real quick. Bought those shares at 230. Stock is now down to 197 and change. So you can do the math. That stock is upside down about $32. In other words, it's gone down, okay? And there's the loss right there. Now, what you're now going to see is the put, and let's just make sure we connect this. The put has become more valuable. Can everyone type in the chat, why has the put become more valuable? Why do the puts gain or lose in value? In this case, why did it gain value? Why? Well, if we go back and kind of look at this trade was placed on the 20th. Okay? So if I went back to this chart, let's just finish this point and then we're going to move on. If I go back to where was this on the 20th and circle that so you could see it, it was right there. So how do long puts gain in value? Well, those long puts gain in value when the stock price declines. How? Well, because there's more intrinsic value. And so what you're now going to see is if you go back and say, well, we have a right to sell those shares at $2.15. And we bought that right for $3.40, and now it's at $18. Now, I'm going to do kind of a little role play with you here today, okay? Let's imagine that today was expiration. Let me ask you a very hard question. I'm joking. Would you rather sell the shares at 197 or would you rather sell the shares at 215? Let me think about that. The investor might say, James, I understood the question. I would rather sell those shares at 215. Well, if the investor says I want to sell those shares at 215, there's two ways they can exit this position. Now, if we look at this position, this does not include the calls that were sold against this. This is just these two positions now. So what you're now going to notice is we're down 32 and we're up 15-ish on that. We've cut the losses in half. That does not include the sold call premiums that we had. What I'm going to do is I'm going to imagine that today is expiration, and the investor says, I want to sell this put, and I want to sell the shares of the stock. I want to manually get out. How do you do it? Well, we're going to right-click on that line, create closing order, and we're going to sell that. That's it. We're going to try to harvest that gain. Now, we've always said, and we're very specific on this, okay? If this stock is going to set the close on the week of expiration below the strike price, the paid money account is going to exit the position. Because if that stock was going to be set to close below the strike price on the week of expiration, that probably tells us the trend has probably changed quite a bit. Okay? Now, we're not in the week of expiration, but let's imagine it was. How do you close the position? Create closing order, sell the put, harvest that gain. How do you sell the shares? Right-click on that line, create closing order, sell the shares. So someone might say, well, but we lost. But I don't think you understand it. We cut the losses in half. If you cut your losses in half, do you think you'd be more profitable? That's a question. Okay? If you cut your loss in half, do you think you'd be more profitable? Okay, now, let's say, for example, you said, James, Amazon is one of my stocks that I'm trying to hold. I've been maybe invested for a long time. I want to try to hold it. And I think we could be near a market bottom for Amazon. Well, how do we sell the put? Right click on that, create closing order, sell. Now, I want to have full understanding here. Notice on this position, okay, I want you to notice the delta, the net delta. When I say net delta, what do I mean? The delta on the shares and the delta on the put. Can anyone tell me how is it possible that the delta on the put is negative 87? Does that tell us that we're in the money? The stock is below the strike? Does it tell us we're at the money? The stock and the long put strike are the same? Or does it tell us that the stock is way above the strike price, out of the money? What does that tell us? You wouldn't need to look. If you had one contract and you're closer to negative 100, that means you are way, 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 way deep in the money. Is that good or bad? That's good, okay? Because that means if the stock goes down $1, we're down about 13 bucks. Okay? So if the stock goes down, the put has done what it was supposed to do. Protect the capital. Okay, now, good. I just want to make sure. Now, guys and gals, so next time you see stocks going down, you shouldn't be as nervous as saying, oh, I don't understand the mechanics of what's going on here. Okay? Now, by the way, this has been recorded. I would go back and watch that last 15 minutes. Okay? You might say, well, this was dumb. But the biggest actually thing is you need to understand there's many people that probably incurred portfolio drawdown where they actually could have said, geez, if I would have understood that or been more confident, maybe I could have offset some of my stock losses, even just 2 or 3 of them. Okay? Now, create closing order. We're going to sell this. Now, I want you to notice something. When I sell this put, can anyone tell me where the net delta is going to go? Can anyone tell me where the net delta is going to go if I sell that put? Where's it going to go? If I sell that put, is my delta going to get bigger or smaller? Well, if I sell that put, let's do it. Create closing order, sell. And if I sell that put at the mid price or try to, confirm, send, the delta on the position is now just the shares of stock. If I have 100 shares of stock, we now have a delta of 100. So wait, if I got rid of the bearish position, the long put, does that make my position more bullish or less bullish? Or the same? The answer is in the number. The delta now tells us 100. That's as bullish as you can be. So the delta is the highest it can be if you have 100 shares. So our position has gone from being kind of more very protective to now we better be right on direction. Okay? Now, what do we have any downside risk protection? We don't. Okay? So what's the risk now? If this stock falls further and further and further and further down, there's no bought put, there's no stop loss. What would a prudent investor do? Well, they would say, James, if you think you're going to get a little turn here, the investor might say, I'm going to set a stop just in case. Okay? Now, if the investor says, I'm going to set the stop below, okay, 191, I'm just kind of showing an example. Let's say they said 191, and let's say they chose for themselves, James, I'm going to set that stop less 2% below that, 187.18. So the problem now is if it goes down to that 187.18, what does that mean for the shares? It means they're fully exposed. What do you mean by fully exposed? It means for every dollar that the stock drops, we're going to be down a full 100. There's nothing offsetting the delta on the shares. I need you to type in the chat so I can sleep better. Do you understand that? So now if I, for example, went back to this little diagram and said, forget all this, and the stock goes down $1, well, if the stock goes down $1, we're down a full 100. Stock goes down another $1, we're down a full another 100. Stock goes down another $1, we're down another full 100. Stock goes down another $1, we're down a full 100 again. I mean, Adrian, throw the towel. And all of a sudden, you're just seeing this, it goes down. It's so stinking painful. Why? Because there's nothing protecting it. There's nothing protecting it. Okay? This is why stock investors, when the stocks go down, they're so stinking emotional. Now, can you blame them? I don't know if you can blame them, but they're feeling the full brunt of that delta. They're feeling every bit of it. There's nothing offsetting. Now, this is why we've kind of slightly discussed, calm down, James, calm down, just investing. That's why these, now, if we kind of said which of the two is more protective, callers or married puts? Well, married puts are a defined risk, so is a collar. But what you're going to notice is a collar has more, it has less net delta fluctuation. And we're trying to get the credit from the short call to buy the put. But we could actually say married puts are typically reserved for lower delta types, lower implied volatility type stocks that have implied volatility, let's say 15 to 24. And if the investor, let's say, has more volatile type stocks, that investor might say, James, I might consider using a collar position. Okay. So now, James, if we had stocks, does the investor consider like exiting what they have, protecting what they have through a married put, potentially, or a collar, those three, okay? Or do they talk about putting on new positions at first? And the example is we don't put the cart in front of the horse. The investor, the prudent one, is going to try to manage or protect what they have. Once the investor has identified exits, considered actually put protection if they considered that, or collar protection, then once they said I've managed what I have, then they might say, hey, now what I'm going to do is going to consider a bearish type of strategy. Now, are there any questions? Now, Peter actually says, would you ever consider selling a call? Now, Peter, are you saying by itself? Are you saying by itself? Now, let's kind of finish this. We got about 8 or so minutes. I want to draw something up and kind of just do some quick examples, at least one. So now what I'm going to do is there's been some questions on bearish negative delta strategies. So when I say negative delta, are we talking about bullish or bearish? Well, we know that if we had a delta of zero is like cash. Or directionally insensitive. I don't care if the market goes up or down. Okay. Now, that's not the only way you can get a delta of near zero, okay? But if we look at this and said, well, what it has like maybe a negative delta between maybe 5 to 15, negative. What we talked about before is it could be a SCV, a short call vertical, and a long put vertical. These are both defined rewards. I should say there's a maximum gain built in what you can make and a built-in maximum loss. Okay, fine. How does the investor actually become more negative delta or put a more directionally sensitive position on? LP, they buy the long put. If they bought the long put, maybe a delta of, let's say, negative 30 out of the money to maybe negative 70 in the money. Okay, so it's more sensitive. It's defined risk. You got to pay for it. And if the investor says, hey, look, I want a position that is kind of using both of these, a long put LP and a short call vertical. Does anybody know what that's called? Does anybody know what that's called? Why don't people buy long puts, even if they know what options are? They don't want to pay for them. Why don't people typically like short call verticals? There's a cap maximum gain. Well, wonder if you sandwiched both of them. Wonder if you said, I'm going to do a short call vertical plus a long put. And what do you get? You get what's the question that was asked is, what is a short synthetic? Okay, now, a true short synthetic is selling the call and buying the put. The con about that is you have unlimited risk by selling a call by itself. We're going to reject that. We're going to do a short call vertical to get the credit to help pay for some of the pet. Now, when you do that short synthetic, that delta is probably going to be about between, let's say, negative 50 and probably negative 60. Okay? So when you see stocks or the market go down, a lot of investors like to have a higher sensitivity to direction. One of the strategies probably the least talked about is a short synthetic. We talked about long synthetics, but this is a short synthetic. A short call vertical, which you've already done, we've already talked about, and a long put, which we just talked about. Now, what stocks are going down? Oh, that's funny. Okay. What stocks are going down? Now, I want to bring up a stock example given. Let's kind of use an example of Nike. Okay. Now, Nike it's been tough. Okay. It just kind of struggled a lot. And so, by the way, this is your homework assignment. I want you to practice really 3 short synthetics. Short synthetics include or do not include stock ownership. They don't include stock ownership. What includes stock ownership? That's like a synthetic that we talked about. Well, you could think about like owning the shares and collaring is like a short synthetic. A collar is a short synthetic, but it includes shares. If you did a short synthetic, it does not include the shares. So we're already doing what we're doing, but we don't have the shares. All right, so let's go to the trade tab. When we did a short call vertical, kind of a place to start, might be looking at the monthly options, 20, 50 days expiration, selling a call vertical above the current stock price. All right, so we've done that before. Right click on the bit of the option that we want to sell. And now what you're going to see in this case is that we've already done this, okay? We're going to sell the call where we think the stock could stay below, and we're going to buy the call above to create a maximum loss. And there's the credit. What is the main purpose of the call spread in a short synthetic? Answer: to help pay for some of the put. How many of you wish you went back and said, man, I wish I would have bought puts in the last 2 weeks or so? And the question is, why didn't you do that? Well, I didn't want to pay for them. Well, did you realize we could do a call spread, short call spread, to help pay for some of that put? Well, when we do that, we're going to go single order, first triggers SEQ, and we're going to come to the put. Now, when the investor does the put, if they want something more higher probability, they might choose at the money. If you choose at the money, it's going to be a higher negative net delta. If we went out of the money, okay, at least a delta 30 or higher, would choose this one or this one. We're going to choose the 72.5. Now, what does this position look like on the risk profile? Okay, well, the position actually is going to look like as follows. So if we click on this right there, what you're now going to notice is all I did is I have 2 bearish strategies. This first one right there is a short call vertical. We've done that before many times. Second, we did first triggers SEQ, and we said add the long put. This is the second bearish position. Now, which position could make more money? Which position? Is it the call spread that can make more money, or is it the put that can make more money? Why is someone even buying the put? Well, they're wanting to buy the put because the stock can go all the way down to 0 and the put could gain more. Okay? So which position is more delta negative? It's the put. Right click on that, analyze the trade. Let's pull it up, see what it looks like. Now, when we look at this position, what you're now going to see is if we take a look at this position, you're now going to see the stock. Okay? If we look at that, let me unlink that, put that back on. We know when you look at a long put, there's a maximum gain, okay? The stock falls all the way to 0, okay? Now, we know that if you did a short call vertical, it's going to make it where there's a maximum loss built in. So on this type of strategy is we have a max loss, which is nice. And then last but not least, what's making this have unlimited upside is the put. So if I took this out and said this diagram right here, that to that, welcome. That is your short call vertical. This right here that has unlimited upside to a point, if the stock went to 0, that's the long put. So a lot of people say, James, I like short call verticals because they get a credit, etc. There's max gain, max loss, but I hate that there's a cap gain. Well, wonder if we added the long put to it. And that's really what this is. You could think about a short synthetic as a caller, but you just don't own the shares. And you think the stock is going to go down. Your homework assignment is to pick 2 more of those. We're going to do Nike. I would like you to practice in the paper money account QCOM. I would like you to practice in the paper money account Target and practice in the paper money account AMD. Those are not recommendations. Those are examples that we're going to follow to see how this strategy works. This class was really built upon the questions that were asked, okay? So I tried to kind of use a little Q&A session to kind of demystify some of the things that we've been talking about and maybe try to answer some of those things that could help you the most. So we're going to do Nike. We'll send it, but I also gave you 2 more to do in practice. I got to wrap it up here. Now, I also want to kind of make mention that coming up next, stay tuned for the next session coming up right at the top of the hour. I want to say thank you to Barbara for answering those questions in chat. Let me know if that was helpful as we talked about understanding delta, okay, on a married put strategy. And the goal is, as we see this more and more, that we understand it more and more as we kind of explain it and show it over and over again. So stay tuned for our next webcast coming up right at the top of the hour. Subscribe to the Trader Talks channel. Thank you, Barbara. Thanks to all of you. And this has been the class on Investor Master Series, Understanding Delta on Your Position. Thank you so much. Take care. Bye-bye.